If you're like many Canadians nearing retirement, you probably have a number in mind. Maybe it's 6,000 a month, maybe 8,000. But for a growing number of professionals, business owners, and dual income couples, the target is closer to 10,000 a month. That's the number that feels comfortable. It's enough to travel, help the kids, enjoy lifestyle. It seems like a pretty good target. But here's the problem. Most Canadians underestimate what it actually takes to generate that level of income after tax and for a sustained period of time. Because $10,000 a month or any other target isn't just $10,000 once you factor in taxes and inflation. You can easily reach your 60s with a sizable nest egg and still realize you're short if you've optimized the wrong accounts or ignored how your withdrawals will be taxed. So in this video, I'm going to break down what it takes to retire on $10,000 a month in Canada sustainably and how to build an income plan that keeps more money in your pocket, not the CRAs. Hi, I'm Stefano Francesca, certified financial planner professional and senior wealth advisor at Next Step Wealth Management with IPC Securities Corporation. If you find this helpful, don't forget to like, comment, and subscribe. It really helps more Canadians see this and make smarter decisions about their retirement. And before we dive in, if you're within 5 to 10 years of retirement, I invite you to click on the link in the description to book a discovery call with me to get your retirement on track. We work with our clients to review their current income strategy, run projections for their target after-tax income, and build a personalized investment and withdrawal plan that helps reduce taxes and OAS clawbacks, makes your savings last longer, and create a steady, reliable income for your goals. Because the sooner you understand how to structure your income properly, the easier it is to turn your hard-earned savings into long-term financial freedom. Understanding what $10,000 per month really means. Let's start by grounding this in reality. When people say they want $10,000 a month, they often mean after-tax spendable income. That's $120,000 a year in net income, which, depending upon where you live and how your savings are structured, you might require roughly $140,000 as a couple to $175,000 in gross taxable income as a single. Why? Because income taxes in retirement can still be significant, especially if most of your assets are in RSPs or RRIFs. Here's the key. It's not just about having a big portfolio. It's about having the right mix of accounts and the right withdrawal strategy to get that income efficiently. Building the foundation, where the income comes from. There are typically 5 main income sources for a Canadian retiree aiming for that $10,000 a month target. 1, CPP and OAS. Together, for a couple, this could provide a solid foundation for lifetime income, especially if both partners qualify for maximum or close to maximum benefits. 2, employer pensions. If you're one of the few who still have a defined benefit pension, this could add indexed or non-indexed income for life. 3, RSPs or RRIFs. For many Canadians, this is the main source of retirement income. Converting RSPs to a RRIF at 71 or earlier and drawing strategically can provide a steady stream of taxable income. 4, TFSAs, a powerful source of tax-free withdrawals that can help you stay below key tax thresholds and minimize OAS clawbacks. 5, non-registered investments or corporate accounts. Dividends, capital gains, retained earnings, and return of capital could play a big role in smoothing cash flow while optimizing taxes. The balance between these accounts determines how efficiently you can draw $10,000 a month without giving too much of it back to the CRA. The math behind sustainable withdrawals. Let's talk about sustainability because $10,000 a month sounds simple, but the math behind making it last is critical. As a couple at age 65, if you're targeting $140,000 per year of taxable income to get you about $10,000 monthly of spending, and you expect CPP, OAS, and a small pension to cover about $60,000 of that, then you'll need roughly $80,000 per year to come from your taxable income. Using a balanced allocation projection of 5% and factoring inflation of 2%, $1 million will last about 15 years if everything goes right. If your withdrawals come mostly from RSPs or RRIFs, you probably face higher taxes and lose flexibility later on. If you have more in your TFSA, non-registered, or corporate accounts, you might be able to stretch those dollars further, even with the same portfolio size, because the after-tax value of those accounts is higher. That's why planning your withdrawal order and having diversified income sources can make the difference between having more time left after money or more money left after your time. Managing taxes and clawbacks. Once you're drawing $10,000 a month, taxes and government clawbacks become your biggest hidden expenses. If your retirement income is too high, Your OAS benefit can be clawed back once your net income exceeds roughly $95,000 per person in 2026. So if you're a couple earning $120,000 net, that might sound comfortable, and you're probably going to keep your OAS. But if you're single or widowed, you could lose part of your OAS and pay unnecessary tax. The solution is income smoothing, deliberately spreading out withdrawals between your 60s and early 70s to stay within the lowest possible tax brackets. For example, drawing from your RSPs before 71 can help reduce your RRIF minimums later on. Using your TFSA strategically in higher income years can keep you below OAS thresholds. And if you have a spouse, pension income splitting can help balance income between partners to lower your overall tax bill. A well-structured plan doesn't just focus on how much you withdraw, it's about where you withdraw from and when. Accounting for inflation and lifestyle drift. One of the most underestimated risks in retirement is inflation. Even at just 3%, your $10,000 per month today will need to be about $18,000 per month in 20 years to maintain the same buying power. I know some of you will say that you won't need that much money in your later phase of retirement for various reasons. I get that perspective, but I'd rather see you with some cushion later on in life so you have choices rather than just settling for what's left over. That's why a sustainable income plan should include growth assets, not just guaranteed products. It's tempting to go all in on safety at retirement, but being too conservative can quietly erode your purchasing power. A well-diversified portfolio combining equities, fixed income, and guaranteed income sources helps offset inflation while maintaining stability. And beyond the numbers, there's something called lifestyle drift. When people first retire, their spending is often high. Travel, renovations, hobbies. Then it naturally declines in their 70s before healthcare costs rise again later. Understanding this spending curve ensures your plan isn't over or underfunded at any stage. What about business owners or incorporated professionals? If you're incorporated, you may already have significant retained earnings in your corporation. In that case, there's often no need to draw a full $10,000 per month personal income right away. Instead, you can use a combination of dividends and salary to fund your lifestyle efficiently. Invest corporate assets in a corporate class structure or permanent life insurance policy to defer or reduce passive income taxes, and slowly transition corporate wealth into personal wealth over time through structured withdrawals. Done right, this approach provides tax-efficient cash flow while keeping your business or corporate savings working for you long after you've stopped working. The key takeaway: retiring on $10,000 a month in Canada isn't unrealistic, but it requires more than just saving aggressively. It requires strategic coordination between your income sources, taxes, and timing. You need to know how much you can safely draw each year, how to structure withdrawals to minimize tax, and how to keep that income sustainable for decades. The goal isn't to hit a magic number. It's to create a retirement plan that gives you control, confidence, and flexibility no matter what markets or tax laws do. If you're a Canadian retiree or within 5 to 10 years of retirement and you want a personalized strategy to retire comfortably, whether your goal is $6,000, $8,000, $10,000 a month, whatever the number, click the link in the description to book a consultation. We work with our clients to test their plans, create multiple what-if scenarios, and show how to make your income sustainable for life. Let's take the next step.